Doing today.
I'm good. Thanks for having me on.
All right. And also joining us is Daniel Foch. He's a real estate broker and the host of the Canadian Real Estate Investor podcast. All right, Daniel, what are we going to be talking about today?
I think the big thing we're talking about today is interest rates and the impact that it's had on the housing market, and really trying to get an understanding for what's going on there and what we can anticipate will continue going on for the remainder of the year and perhaps for the next little bit. First off, Robert, thanks for joining us today. And according to the Canadian Real Estate Association, or CREA, their house price index that is published shows that the benchmark composite home fell in August and has basically been falling, I think, for 7 months in a row. Do you think that we'll see this trend continue? And what's your take on this broadly? Like, what does this mean for Canadians and what's happening here?
Well, so I think it's early days in the housing correction, right? Corrections in housing tend to take some time to play out. Like historically, we're talking like 2 or 3 years to bottom and 5 or 6 years to get back to peak. Obviously, every cycle is different, driven by different factors. But this one is driven by a very difficult factor, which is probably the most abrupt increase in interest rates that we've seen in a generation. So going back to the mid 1980s. So given where valuations were and where housing activity was coming into this tightening cycle, and given how sharp this tightening cycle is proving to be, it's really hard to get away from this without a pretty significant and drawn out correction in prices. So, to answer your question, I think we're going to be struggling right through at least the middle of 2023 with prices coming down, and then beyond that, we could be looking at a period of stagnation for a while too, as the market just readjusts to the higher interest rate world.
Mhm. So then what are your thoughts on the Bank of Canada and its recent 75 basis point hike? And how will it affect the housing market in the coming months?
Well, so the Bank of Canada is not done raising rates. I think that's pretty clear. We're looking for at least another 50 basis points of tightening at the next meeting. We could very well see more than that too. Like we could very well see the BOC's policy rate pushed to 4% or slightly higher by the time we're done. It really depends on how quick core inflation comes back down. And as we look at the numbers now, we'll get a CPI report tomorrow in Canada as well. Core inflation is proving to be pretty sticky in both the US and Canada. So every inflation report we get that shows sticky core inflation, the market ratchets up expectations for rate hikes. So there's more to go on that front. And what it means is that there's just more for the market to digest. And the funny thing now is, like, as much as prices have come down and activity looks pretty soft through the summer, the market now is still kind of leaning on pre-approvals from a couple months ago, before the Bank of Canada raised rates 175 beeps. So that kind of just it's one example of why these things take time to play out, because why monetary policy takes 6, 12, 18 months to actually filter through the economy. And real estate's a good example of that too.
On that note, the lagging impact of the existing pre-approvals and, with the impact of the recent rate hikes, I think the other component being, people only have to pay their mortgage once a month, right? So it also takes them a while to reach an arrears position. Is this a point of interest or a metric that any of the economists are looking at? Do you think the Bank of Canada is looking at this? I know we've heard Tiff Macklem mention employment as one of the leading factors that he feels is a risk to delinquency. Do we think that there's any potential increase in mortgage delinquencies in the near term, or will we see any similarly direct impact from the bank rates to homeowners?
So it's an important question, right? Because what we're looking at now is really just an adjustment in asset prices, and that's fine if it stays contained. It's necessary. We knew it was coming. Where it becomes a bigger problem is if it starts to spill over into the broader economy. I would say there are, like, historically, like, Canada is a very low delinquency country, right? Even when you go back to some really bad shocks, like through the 1990s, delinquency rates historically have been pretty low. And just the system in Canada and the lending standards in Canada are geared very differently. And I know everybody likes to look back at the US in 2008, 2009. And that is not at all a comparable situation, right, to what we have in Canada. I think we all know that. The other thing is, there are a couple of reasons why like households should at least for some time be able to absorb this shock, at least from like a delinquency perspective. Yes, discretionary spending is going to get cut back for sure, but in terms of actually ability to pay, one is the job market, historically strong and it's historically tight. And the Bank of Canada's hope here is that they can actually soften the demand side of the job market because there are a million job vacancies out there without creating a lot of unemployment. So that's maybe one area we can fall back on. The second thing is that households built up like almost $300 billion of excess savings through the pandemic. It's more than 10% of GDP. So yeah, some of it's been lost in equity, some of it's gone into real estate, ironically, but that's another area of support households have. And then I would say the last thing is that we've stress tested pretty much everyone at 5.25% through at least the latter stages of the pandemic when the market got really hot. And it's a good thing we did because they're going to be rolling into mortgages that are probably about 5.25%. But so in theory, on the books, the capacity to pay should be there unless we get a really, really destructive break in the job market. And we're looking at a weaker economic environment next year for sure, but not 10% unemployment, which would really start to make this a serious question.
Right.
Now, I know inflation is such a big problem in Canada and especially in the US. What are your thoughts on the Feds and how they're handling inflation right now?
Well, it's a pretty similar situation, right? So we're here from the Fed on Wednesday, and the messaging from the Fed has been pretty consistently hawkish, right? We actually went through a period in through most of the summer where there was a lot of talk in the market, and you saw it reflected in market pricing that maybe the Fed is going to back off, and maybe we're going to start to see some rate cuts in 2023. The Fed came out and said, like, guys, like it's not going to happen. We have 6% underlying core inflation, and we have to tighten through it until we get back down towards target. And I mean, their messaging for Wednesday has been at least 75 basis points. We'll probably see another 50 after that, and probably another 25 or 50 after that into the end of the year. So very easily, again, like Canada, up above 4% on the target rate. And I would say, if anything, like the inflation situation there is probably looking a little bit stickier, a little more persistent than in Canada. But they do mirror each other very well.
There's a lot of talk about, whether or not Canada has to fall in line with the Fed and their hiking expectations. I know we have predictions for the FOMC next FOMC meeting on the 21st, I guess. I think so this week, that we will see likely 75 basis points, but also forward-looking predictions into December, seeing, like you mentioned, the Fed funds rate over 400 basis points, and that Canada will likely have to be in the similar target. Otherwise, we sort of risk offsetting the currency too much. Is that why I would say most people in your position are looking a lot, almost equally, at what's happening in the States as much as we are in Canada, because the Bank of Canada is almost in a position where we really have to stay tight to what the US is doing?
Yeah, we tend not to deviate too much because our economies are very linked, and our capital markets are very linked anyway. But I would, like, you bring up a few good points here, and I would say a couple of things. We generally lean towards more tightening in the US than in Canada because the labor market looks even that much tighter. And because, keep in mind, like the US went through like 10 years of kind of household deleveraging coming into the pandemic after the financial crisis, right? Whereas Canada was consistently levering up over that period. So I would argue that like the sensitivity to interest rates in Canada is higher than in the US because of that. And so the point at which the economy here breaks from higher interest rates is probably sooner. So in our official forecast, we do have the Fed raising rates a bit more because of that. The flip side is that if the market does start to price in a lot less tightening in Canada, it pulls down the Canadian dollar, and a weaker Canadian dollar obviously imports more inflation into Canada. So it gives the Bank of Canada this other problem where it gets harder to get inflation back to target. So we can't deviate.
Okay, Rob. So you were just quickly mentioning the idea of importing inflation. Now we can't deviate too much from the Fed, and I was personally exceptionally interested. So I'd love to hear you continue that one.
Sure. So so I don't know where we left off here, but basically the story was that the the Canadian economy is a lot more levered up, right? Especially the household sector. So it stands to reason that the Bank of Canada can't raise rates quite as far as the Fed because the breaking point for the economy will be sooner. But the flip side is that as like the more and more the market prices in less Bank of Canada tightening, it pulls down the Canadian dollar. The offshoot of that is that in Canada, we're importing more inflation through that channel. And so it kind of works counter to what the Bank of Canada is trying to do.
So Rob, so the prices of homes are basically decreasing. So what is your advice for potential home buyers? Is it the right time to buy?
Well, so this is always a personal thing, right? If you're a young family that needs a house, I'm not going to say no. But strictly like from a financial perspective, I think there's
Mm.
no need to rush here, right? Like there's a lot of time to be patient. Um, Part of the problem is that yeah, prices are down 10 or 20% in some markets, but they're only down because interest rates are rising, right? So we still haven't actually absorbed the increase in interest rates. So from an affordability perspective, things are no better really than they were a couple months ago, even though prices are down in terms of carrying costs and things like that. So I would say there's more adjustment to come. And typically the way these things play out is when you see this initial phase of the correction, you scrub out a lot of the froth and a lot of the psychology in the market. And then you have a longer period where prices actually adjust to reflect interest rate fundamentals. And so that probably takes us into 2023. And then realistically, the way these cycles tend to play out is that eventually higher rates cause the economy to slow down, causes the Bank of Canada to then reverse and start cutting interest rates. And then at some point down the road, you get really the sweet spot where prices have fallen, interest rates have then been cut, and the cycle is starting to pick up again. And that historically is really the sweet spot to start aggressively buying real estate. It's not now. It's probably not the first half of next year. Maybe second half of 23 into 2024 is when we start to see that. So bottom line here is there's a lot of time to work with, and you can be patient, I think.
Yeah, I guess it really depends on how the Bank of Canada's rate hiking cycle ends up looking and when we can expect to see a pivot. On the points that you mentioned prior. When you talk about the broader idea in Canada, we have this thought that the Canadian real estate market is in a state of excess demand, right? Or that we have a shortage of supply, you could say as well. And this is obviously more in the context of urban economics or planning policy, but do we actually have a shortage of homes, and are we going to continue to be in that state of excess demand for the foreseeable future in Canada, especially given the ambitious immigration targets that the government's been putting forward? Or and I guess, does that almost give us, I don't know, a speedier ability to correct the housing market from that sort of trough area like you mentioned? Like, how does that all factor in?
Yeah, no, I think the demographics are a big story, and it's something we've been harping on for a long time, actually, probably going back like at least 5 or 10 years now. The demographics are very supportive. International immigration is a big one, right? You mentioned that 400,000 or 500,000 people per year need a place to live. The millennial cohort is peaking out right now, and probably will peaking out over the next couple of years in terms of peak home buyer demand in the millennial cohort, right? I think the biggest chunk of the millennial group is something like 32 or 33 years old right now, and they're making families and looking for houses. So that's been the story all along. And we do need supply to meet that demand, and we need a different kind of supply than we've building over the last 10 or 15 years, which was smaller, single unit condos. We need single attached supply, and there's not a lot of it. So fundamentally, I think that is still there. Really, like what we saw through the pandemic was those fundamentals didn't really change, but we saw a lot of froth and speculation build up on top of those fundamentals. And that's what we're cleaning out right now. And I know we've been out there in the media saying like we don't have a supply problem. It's not to disregard the issues we have on the supply side. It's just that on the ground today and over the last couple of years through the pandemic, it's just been an acute increase in speculation and house prices driven by policy that was left too easy for too long. That will get cleaned up, and those demographic fundamentals will eventually help to set a floor under the market. I do still think those are in place. Yeah.
So according to your BMO AM chart on September 15th, you talked about how, quote, many potential buyers have pre-approvals in hand from before the big wave of BOC tightening, while also looking at 10 to 20% discounts on home prices. Can you explain more about this and what does that mean for the current market demand?
So yeah, so what we're getting at there is just that these cycles take time to play out, and there's more to come in terms of the correction and how long it's going to take to absorb this interest rate shock, right? And so what I mean there is you walked into a bank in June and you got a mortgage pre-approval. Bank of Canada raised rates 100 basis points in July, raised rates another 75 basis points after that. You are still out there in the market looking at prices in some cases that are 20% lower, and you have a contract for a mortgage rate that no longer exists in your hand. For some people, that could be a pretty appealing combination to get into the market right now, especially depending what your expectations are. So I think we've actually seen a little bit of a pickup in demand through the late summer because of that. But what's the reality going to be in November, December after these 120, 130-day pre-approvals roll off? It's going to be a market that's fully priced at 5% mortgage rates, variable and fixed. It's another pretty big pill for the market to swallow once we fully absorb this.
Fair enough. Great insight there. I think we only got about three more questions. We'll probably just do the last three here in the list. Robert, given what was happening in the market prior, we obviously saw an extreme run up, and some people were describing that as almost a sense of mania in the market, especially with the speculative activity that we were seeing, and a lot of people really trying to get into that housing asset, or in a lot of cases for Canadians, it's almost like a trade, right? That you're really trying to gain an opportunity to capture that capital appreciation and not really investing for yield or other reasons that somebody might pursue a real estate asset. From your personal perspective and just the perspective of most people in the economic space, was this considered to be a bubble by most definitions of the term? Understanding that we can typically only characterize a bubble in hindsight. Are we kind of seeing it unwind here in real time, or is it still too early to call that?
Yeah, it's kind of an academic concept, right? Is it a bubble or not a bubble? So for me, what I look at for most asset classes and real estate too is, and real estate especially, because you have just fundamental factors that drive and justify house prices. You have incomes that grow or fall, you have interest rates that rise and fall, and you have the price of the asset. And typically, when you look at something like the carrying cost on an average priced home as a share of income, historically it's kind of been pretty steady. And for a lot of, like, funny thing is, for the almost the entire period from 2010 through the pandemic, I personally have been taking a lot of calls from US hedge funds looking at Canada and saying, it's a housing bubble, it's a housing bubble, we want to short Canada. And for 10 years I said, guys, just stop. It's not, right? Incomes are rising, interest rates are falling, we have supply side constraints in single detached housing. Prices are rising because they should. It's all explainable by those fundamental factors, right? Midway through the pandemic, it all started to change. Prices took off well in excess of those changes in incomes and interest rates. And we could kind of see anecdotally that there was a lot more of people buying houses just because prices were going up. And I think that, like, at the end of the day, when you have prices rising simply on the expectation that prices are rising, that's a classic characteristic of a bubble. And when it's fueled by, or when it's allowed by, excessively cheap credit, that's another telltale sign of a bubble. So yeah, we saw a lot of that. And I think one of the big reasons why we actually went out publicly, like right at the start of 2021, and said, like, Bank of Canada, you got to do something because this market's going to get away from us. That's exactly what we were seeing. And unfortunately, they came in a year too late.
What is your long-term view of the market?
Well, I think we're going lower for probably the next year, and on a very rough timeline here. Obviously, inflation and the path of rates is going to dictate it, and the outcome of the economy. But our base case forecast is that we have something that looks like very little growth through the turn of the year, and we have policy rates peaking around the turn of the year. So that would have housing kind of bottoming out around the latter stages of 2023. And we talked about some of the fundamental supports that are out there. I think those are still in place. And, it could just take a couple of years beyond that to still absorb the increase in interest rates, because this, like everyone says, well, in the 1980s, we paid 13% or we paid 18% on mortgage rate. This is still cheap. It's not, because we're coming off 1.5% mortgage rates. When you go from 1.5 to 5, it's a dramatic increase in the cost of capital. And it's a big adjustment that the market has to absorb. So it's the change that matters. And it just takes a lot of time to absorb a change like this. So I know that's a long-winded answer, but the short answer would be we're going lower still for the next year, and then probably sideways for a while, and then fundamentally we start to eventually push higher again.
Awesome.
All right. Wow. Thank you so much, Robert and Daniel, for joining us today. And thank you to all our viewers for listening. We hope you have a great day, and we'll see you on the next one.